Wednesday evening, 8 p.m. Eastern, could only mean one thing. Of course, I'm referring to bingo at the local VFW hall. Just kidding. Well, actually, maybe it is bingo. I don't know. But it is Taxes and Retirement. I am your host, Andy Panko. Got a special one tonight. We got a hot one. A guest you all know and love from within the group. Our very own, drum roll, please. Oh, Cody Garrett.
Bingo.
Financial planner, owner of the Measure Twice universe. Hello, Cody.
Hello there.
What's happening?
Not much. It's been a busy day. I've been excited about this. A lot of people sending me messages, asking questions, and looking forward to the show.
Hate mail?
Hopefully. Mostly hate mail, but I can a few good ones get through. So we'll at least get to 20 minutes in.
Okay. And I'm to commemorate the occasion, I'm wearing my Texas t-shirt here in New Jersey, but you are in Texas. So here we go. Just like that, we're linked all of a sudden. Magic. Right? Yeah. So tonight's topic will be accumulation versus decumulation planning. Now, we'll get into that throughout the course of tonight. But in essence, accumulation is leading up to retirement effectively. You're accumulating your financial assets, which is what Cody focuses on in his day job, his professional side. Whereas myself focus more on the decumulation. That's kind of what Taxes and Retirement, the group, is all about. Once you've hit retirement, you've kind of saved, you've accumulated already. Now it's how do you best make use of that or decumulate, spend down that portfolio. And there's different ways that you invest, different mindsets with accumulation or decumulation. So we will get into those fun things. Before we start, I will ask you some questions, Cody.
Sure.
Why was the Quaker truck driver an 80s pop star?
Something about Hall & Oates.
Oh my God. Yes. Because he was
really?
Hall & Oates.
Are you serious? That's awesome. Yep. Okay. I won't guess the next one probably.
All right. No, do it if you can. But
so I should tell everybody I used to be a professional musician. So that one was kind of.
Yes. Cody was, but still is quite the pianist, right? Mm-hmm. Amongst other things. So this one's a statement, so you can't ruin this. It's a statement, not a question. A gymnast walks into a bar, he gets a 2-point deduction and ruins his chances of a medal.
Oh, man.
I figured that was appropriate because it's Olympic time. I'm glad that the 97 days of swimming seem to have come to a close. Now we move on to track and field. All right. So I went to the hospital. Where am I? I went to the hospital today. I said, I've been bitten by a wolf. Doctor said, where? I said, no, just an ordinary one. Yeah, I was going to ask you to try to laugh like that kid, but I figured let me just use the overlay.
Last year, I used to laugh like that. My voice has gotten a little lower since I started my own firm. So
you stop singing.
It's more like ho 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 ho. Yeah, exactly. Right. It's changed a little bit.
All right. Before we really get rolling, just usual disclaimer: this video is only general explanations and education. It is not specific tax, legal, investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor, which neither Cody nor myself am, unless we coincidentally are in a professional engagement with you, which you would know. But here, what we're saying and doing within tonight's stream is not specific advice to any of you watching. So, cool. All right, comments are working, and this is going to be weird because usually Cody's kind of the one in the background, like look at the comments, answering questions. Yeah. Now here he is, presumably attention front and center on the camera as opposed to looking at all your comments. So, but comments are working,
and I can see them, which is kind of crazy. Yeah.
Did you see David Foltz likes your microphone?
I did. Yeah, and David Foltz always says howdy right away, so he's an OG. He's always here. Like he probably refreshes over and over again until it shows up.
And he made this a full sentence. Howdy, period.
Howdy, period. That's right.
He's so proper. I love it. Okay. All right. So accumulation versus decumulation. What would you like to say about that?
All right. So this, talking about accumulation versus decumulation, kind of, transition from my background. So I was a lead of financial planning at another firm previously for about 2 or 3 years. And there are two sides of business. One was traditional wealth management, where I'm working with people primarily, in that stage, like 5 years, transitioning into retirement, and then all the way through retirement, really till the last dollar spent, right? And then there was another side of the business, which was 401k administration. And one thing I liked about that is I was able to help educate the plan participants. So, part of the business, I'm working with people like, into their late 90s, like really getting hit by the RMDs, doing Roth conversions, and between the gap between, retirement and when all those important decisions start. But I was also working with people like in their first job, like they were like, hey, what is an employer match, right? Talking about the importance of the compounding effect, not just of money, but of thinking about our money in terms of time, and educating more plan participants. That's where I really started creating educational content online to serve people like that who weren't being necessarily served by the big wealth management firms, or at least not yet. But they still needed that education to, that's the thing. We primarily focus on decumulation and like, what do I do with all this money? But one thing I heard over and over again from those, especially the older clients, was, man, I really wish I knew about this stuff while I was working. So, this would be, part of it is maybe less painful, right? In terms of like, there's a lot to do now because I kind of, I accumulated this big, the nest egg, right? And now there's like yolk, spilling out everywhere. So they're like, well, if I would have spent the last like at least 20 years, maybe like, really refining my path to retirement, maybe at this point I'd have a lot more flexibility with my time, but also making sure that I have a lot of balance and control over my taxable income. So taxable income, right, is like the biggest conversation in the group, which is mostly, hey, I've gotten to this point. Typically, it's, I have got all this pre-tax money, right? It's this big, you can call it a tax burden or tax bomb. I know it just depends on, which book you're reading.
Yeah.
But there's certainly a level of regret when people say, oh, wow, like now I have this big thing to worry about and I don't want to pay any more taxes than I need to. So taxes and retirement, right? Andy's like really, at the forefront of this awesomeness. And so what I decided to do is, working at that traditional firm with mostly retirees, I decided to step aside and focus just on planning, not wealth management. But my focus in terms of my ideal client or ideal family that I work with are people who are on the path to early financial independence. And the way I describe early financial independence is the ability to maintain your desired lifestyle without earned income. So really being work optional within 10 years. So I would say the majority of the families I work with now are in between like ages like 35 and 55. They've accumulated some assets. A lot of them have, a lot of income that they're trying to find ways to put in tax efficient ways, but also balance that with really the cash flow flexibility that they're going to need in early retirement. Just a quick aside, a lot of times we talk about, traditional retirement after 59 and a half. The Social Security, we think about full retirement age, which, for people like me is going to be age 67. But we really focus on those traditional ages. But people who retire before 59 and a half, they feel kind of stuck, like, ooh, all my money is not only in pre-tax accounts, but there's this big 10% early withdrawal penalty. So there's some special opportunities for people specifically who want to retire before that age and pull retirement income.
Great. Yeah, it's like you said before, it seems like most of the industry focuses on the decumulation planning. There's a few reasons for it. That's kind of where the money is. And historically, most industry charges on assets, percent of assets. And it's not until you're retired that you can typically roll your money out of your 401k, which is where most people's nest egg is, financial nest egg. So there's reasons why, the advisory industry is focused on that. But thankfully, in the last 10, 20 years, probably more so 10 years, there are folks like you and people who realize, no, just because you're not over 60 doesn't mean you don't need or want or could benefit from financial help. And now there's creative and different and frankly more logical ways to charge for that, as opposed to having to manage assets and having to charge a percentage of it. But yeah, that kind of explains why so much of this industry was decumulation focused. Now there's much more emphasis on accumulation, as opposed to, well, people kind of figured it out themselves. Maybe not so great historically, but people kind of figured out themselves. And then you got this hodgepodge of stuff that you would then go to a traditional advisor to help you decumulate it. But what if you could have got help decades earlier, right?
Right. And what you might have noticed, especially like, millennials, especially, like they're becoming more aware of their options. Like they're actually looking at their summary plan descriptions, which is, it describes your retirement plan at work. They're saying like, hey, like the first time they hear like, you have the option of choosing for traditional and Roth, and like just that first option makes them go, okay, I should probably learn more about this before. You always hear that you shouldn't invest in something you don't understand. So especially millennials who are there's a lot of curiosity, certainly, and also kind of testing the status quo and really doing a lot of research. So accumulators now are actually doing the same amount of research that decumulators in retirement are, but in terms of financial education for accumulators, it's primarily one size fits all approaches. Like we might have heard that save 12 to 15% of your income toward retirement, or your emergency fund should be 3 to 6 months living expenses. Or in the financial independence community, it's almost like, hey, like this is the ticker, like this is the fund you should be investing in.
Right.
Whereas there's a lot of one size fits all, like dogmatic advice. Retirees certainly wouldn't be pleased with that. Just being like,
no.
Oh well, you might have heard the 4% rule we talk about, right? But if an advisor just told everybody, or financial media just told everybody, pull 10% from every account, every year, you'd be like, there's got to be more to that. Because and one reason I'm excited to be on the show is one thing I've taken notes here on is that really finance is personal. I know that Andy's talked about this a lot, and anytime you see the phrase "it depends" in the group, take a drink, because that's something where there's a lot of financial education that we can provide. Just like here's a link to the IRS article about this. But when people say specifically like, hey, should I contribute to traditional or should I contribute to Roth? It all depends, and thankfully it depends, because finance is personal. And really our roles as financial planners, advisors, is to help people align their money with their personal objectives and values, really getting, beyond the one size fits all. So I'm excited to be in a space where I can provide that personalized education to people who really want to go beyond the basics. And ultimately, when they get to traditional retirement age, like they're going to have a really good balance. For example, we talk about tax location, right? Like, hey, instead of having all my money in pre-tax, maybe we can start refining your plan now, because we know all your retirement savings options, and you can say, hey, and I know you mentioned there's no rule of thumb for like, you have to have 33.3% in each of the pre-tax, taxable, and Roth. But it is important to think about like all of those different account types you have provide different levels of both like tax characteristics, certainly, but also cash flow flexibility. And this is especially important if you want to retire, before you're hit with a penalty.
Yeah. So I guess from trying to pull this back to compare and contrast accumulation versus decumulation stages of life. I guess for the most part, everyone, all the stuff you see in the group is kind of decumulation focused. So you can sort of piece together what decumulation planning is. But accumulation planning, is it oversimplifying it to say it's just simply, take this 60-year-old version of you and go back to the 30-year-old version and say, man, I wish I would have done this differently? Do you help people kind of have that multi-decade foresight to get the account allocations, contributions sort of redirected, so you're not just pumping everything into tax-deferred accounts?
Yeah, that's perfect. I mentioned on Facebook, like Stephen Covey, that whole like begin with the end in mind. Most financial decisions are a lot easier if you think about the end in mind. First of all, like retirement as an end in mind, but also when people say like, hey, I have all this money, what should I do with it? Right? Like instead of just like choosing where to go, right? So there's two parts. One is that we have to really figure out like where we're going. There's a little thing that I tell clients a lot is we have to determine where you are before determining where to go and how to get there. Yeah. Right. So I guess I'll go ahead and dive into that part. I sent you a little PDF there of the types of things I look at. If you can bring it up.
Yes, I can. Share. There we go. Okay.
Perfect. So this is an example of a data gathering checklist. So this is something that an advisor might, they give you this, really, this is your responsibility as a client to say, hey, like, before I can give you any advice, not only as like a fiduciary, but like really just to give you advice that aligns with your objectives and values, I need to know all these things about you. And whether or not you have an advisor or not, these are all the really important documents that you should look at on an annual basis to ultimately to figure out, first of all, where you are, but also figure out, if you know where you want to go, you're like, okay, how do I, which vehicle, in terms of investments, right? Which vehicle is going to get me there? Like, do I have access to a pension, right? I know pensions are, a lot of those are going away. Like, do I have access to a 401k? And what specifically, like, what are the features within my retirement plan? I I know Brian Williams is in the group here. He's a big, awesome 401k educator. So we're glad to have him in the group. Looking down, there's certain things like health savings accounts, right? Starting to think differently about, hey, a health savings account, for example. A lot of families, they see that like a flexible savings account where they put money into it, but they spend it along the way throughout the year. And one thing I really like to look at, just as an aside, is health savings accounts for especially young accumulators. They can start thinking about their HSA. If you have access to an HSA through a high deductible health plan, then you can actually think of your HSA as a funding vehicle for long-term care.
Exactly.
For example, I've got a little, I've got my financial calculator here. Let's say somebody has $30,000 in their HSA at age 30. 35 years from now, age 65, let's just use a 6% annualized return without adding any money to it. That $30,000 could turn into $230,000, right? That's a pretty sweet long-term care account that can be accessed, not only to pay for those medical expenses, but also, reimbursed for all the medical expenses that happen along the way. So that's just one account type that, just learning more about all these different investment statements, liability. So understanding, just like every investment has a time horizon, it's talking about giving every dollar a use by date. When you look at your liability statements, figure out like not just how much is my monthly payment, how much interest am I going to pay over time, but what is the repayment period of my debt? Like some people, for example, they say, hey, I know there's this whole debate about paying off your mortgage or investing the rest, right? But I really want to have my mortgage paid off by the year I retire. It's just really nice. It's going to free up cash flow, and I'm just not going to have any more debt in retirement. So thinking about money in terms of time again, using liability statements can help. I wrote a recent article on measuretwicemoney.com that's about how to understand your pay stub. Now I guess nobody has a pay stub anymore that they rip off, but
pay statement, I guess. Yeah.
Yeah, exactly. Yeah. Pay statement. Understanding your earnings, your deductions, your taxes. A lot of people think that, really that the only thing in your control is what ends up in your bank account, that net pay from your pay statement. But there's a lot of things that are actually in your control that are coming out of your pay statement, out of your gross pay. So just, again, I won't go through all these, but this is the level of awareness that I think is very helpful, regardless of what stage you're in. Whether in your 20s, 30s, or even if you're already taking Social Security and you're paying IRMA, you're paying Medicare premiums. Like there are still some documents here. I tell clients all the time that there's 3 documents. If I have it, I can tell a story about you. It's if I have a pay statement, if I have your tax returns, and if I have your Social Security statement. Like sometimes those 3 things, I almost know more about the client than they might know about themselves.
Right.
Both from a quantitative financial standpoint, certainly all the black and white numbers, but also qualitatively, like I can tell on a tax return, where you give your money. Like, do you give to charity? I can tell if your charitable donations are actually if you're getting a tax advantage for itemizing, or if there's opportunities for a donor advised fund. Some of the fun things we talk about in this group, but really, if you look at all these statements on an annual basis, your awareness will grow so much. And one thing I tell clients a lot is the gap between risk capacity, which is really like your objective ability to take risk with your money, and your risk tolerance, which is kind of the behavioral, like how you feel about the ups and downs of the risk. The gap in between risk capacity and risk tolerance is really education and awareness, right? So the more you can align those 2 things, the more you can sleep at night, whether in retirement or on your path to retirement.
And those 2 things, again, risk capacity is sort of like the quantifiable, financially, how much risk can you afford to take, or do you need to try to take to get a certain amount of growth? And risk tolerance, which is indirectly it's impacted by risk capacity, but in theory it's completely separate. It's just your emotional views towards taking financial risk, which there's various different calculators and questionnaires to try to quantify.
Very difficult for some. Yeah, if you ask somebody, what's your risk tolerance?
Medium.
I think middle. Why middle? I guess that's just that. And I would say in terms of risk tolerance, with working with 401k participants, a lot of the times when they're filling out the risk tolerance questionnaire, they look at the person next to them and say, "What'd you put?"
Right.
Right.
Yeah.
There's, it's really easy to get caught up in kind of doing what other people are doing, especially in terms of risk. I'll go ahead and there's a question that was sent to me before the call tonight. Hopefully, is it Kanan? Do you Kanan?
Kannan.
Yes.
Kanan.
Yeah. Also, awesome contributor to the group. He says a couple questions for tomorrow. He said, in my view, there are 3 stages in your financial life: accumulation, maintenance, and decumulation. Each of these stages is different for each individual family unit. How does one prepare for decumulation after decades of accumulation? Right. What are some considerations for this stage? So we'll talk a little bit more about risk in my answer here, but what I wrote down was, give every dollar a use by date, right? So this typically means, when we talk about risk capacity versus tolerance, this usually means, when you're in that maintenance, like kind of, hey, I'm going to retire maybe in 5 years from now.
Yeah.
Let's see, I'll move this over here.
Do you want that PDF back up?
Oh, no. Yeah.
Okay.
Yeah, we're done with that. Good. Thank you.
Just quick. Someone asked if you're able to share that after the fact.
Yeah, I'll,
Okay.
yeah, you can.
Okay, we'll follow up.
Yeah, you can send it on. Yeah.
Okay,
I'm happy to share. So really, in terms of risk capacity, when you're transitioning, from accumulation to decumulation, really money, again, thinking about your money in terms of time, money that needs to be spent, within the next 5 years, for example, right? Like, that's where you start thinking about, like, okay, well, I need to maybe wind down, maybe de-risk some of these, maybe take some equity. Traditionally, you take some like equity off the table, look at some fixed income, but also look at the tax consequences, right? Depending on which account it's in. A big thing, and a big thing I put here is that when you're in any stage, whether you're in retirement or not, look at your total portfolio. So, for example, somebody will say, I want my total portfolio. You hear people say traditionally, I want it to be a 60-40 portfolio, like 60%, equity and 40% fixed income, or, stocks and bonds. And a lot of people think stocks are risky and bonds are safe, which doesn't necessarily the case, but that's like kind of the generalization.
Yeah.
So as a total portfolio, you could have a 60-40 portfolio, but that doesn't mean that every account you have needs to be 60-40 and exactly the same, right? So there's opportunities for you to, again, think about money in terms of time. Part of that 40, the fixed income portion, is actually more aligned with liquidity needs, stability needs for maybe the next 5 years. Whereas part of that 60%, the equity of your total portfolio, can be in some of those more aggressive vehicles, that not just aggressive vehicles, but money you aren't going to spend for maybe decades, or maybe even money you expect your heirs to inherit. Like at that point, maybe you can think about, hey, I should align my investments in this part of my portfolio with my heirs' risk capacity, not mine, because I don't expect to spend, especially people who have pensions and Social Security that meets their needs and wants. So really thinking about, when he says, like, how do you make that transition, you really start thinking about time and making, not only creating that, de-risking some of the short-term money and making long-term money maybe a little bit more aggressive. But also a big thing that I think came up on a recent call was, like, when you're working, when you're working for your employer, for decades, maybe you're getting a paycheck on the 15th and the 1st of every month, right? One thing that really helps, especially emotionally, with that transition of retirement is, hey, let's set up an automation with my accounts at Vanguard, Fidelity, Schwab, wherever they are. I'm going to set up automation that I get paid from my portfolio on the 15th and 1st of every month, right? That's a simple thing you can do to provide some stability to your life, especially every other part of your life is very different. You're like, maybe you don't have an alarm clock anymore. You're finally eating breakfast and dinner with your spouse. Like, these awesome opportunities. Maybe you're traveling the world, but you can have that one piece be stable, and like, you can look at your bank account and go, oh, I got paid. I got paid this week, or like, I'm so excited to get paid this Friday. But automating it really helps in the transition.
Yeah, I think that's a big part of the sort of mental, psychological aspect of transitioning, Canon. So yes, if your comfort for decades has been getting a paycheck every week, every 2 weeks, once a month, and that just stops, you may not be comfortable spending your nest egg. And partly also because you've spent the last 30, 40 years building, coddling, watching it grow, the nest egg. Now, not only are you no longer contributing, but you're taking from it. And, that can feel painful. So different people have different things that will help them get accustomed to it. And frankly, some don't. There are some folks you read about or know about perhaps that died with $4 million and they lived like absolute, in destitution. Is that the right word? Absolute destitute, or you would think they were, because they were so hesitant to ever touch that nest egg. And who knows, maybe that ended up making them happy or happier than if they would have spent from it. They would have been that much more sad and upset. But so the answer, I think, is different for everyone. But there is definitely a psychological shift. And the more you can kind of segment or bucket or give yourself paychecks or whatever mechanics help you sleep better and help you get over that hump is the answer for you. But it depends.
And it's funny, you perfectly transition into another question somebody asked. So Nathan asked, we got some help from a fee-only CFP who has actually reduced our savings rate to about 50%. We were at 70%, right? And then down and down as we get older, as our income increases. We have a very difficult time spending money. So this helps us from living in the spreadsheet. Still, it's hard to stick with the plan and not continue to dump money in our investments. And this is certainly true. I think, especially when people think about the financial independence early retirement community, they think, hey, like these people are eating like, cat food. And these people are eating like rice and beans, like for decades in a job they hate, so that like someday they can live the lifestyle that they desire, which actually isn't the case with most of the community. But the three things that I think that you can do yourself, but I walk through with people is there's really three things we have to do when determining how much to save. I'm sure there's a common question, like, how do I know how much to save in the accumulation stage? Number one, we have to determine your retirement savings options. So like, what are the plan types? What are the like tax characteristics of those plans that are available to you? For example, your IRAs, employer sponsored retirement plans, HSAs, taxable brokerage accounts, Social Security, right? A lot of us, again, we don't see Social Security, that 6.2% coming out of our paycheck, on the employee side, every paycheck. So understanding what your options are, like, for example, it's not all of us have, a pension. Not all of us have a 457B and some of those awesome features. But ultimately, you just, again, go back to like, what do you have as an option to save for retirement? Number two is determine your retirement savings needs, right? There's plenty of calculators out there. I know some people use, you might get, like New Retirement, one of those planning softwares, or simply go to, I think most of the custodians now, like Fidelity, will tell you, you type in some of your data and it'll tell you how much you need to save to get to this goal. Thing is, once you know that retirement savings need, this is the most important thing that I think most people don't necessarily do in a personal way, is create an order of operations, right? Figuring out, okay, how much money do I have available to save, and in what order and how much in each of those accounts should I put this money, right? And without having an order of operations, it's really easy to stick all your money, just say all my savings is going into my 401k and that's it, right?
So
yeah, go ahead.
Coincidentally, a great question. I can't tell who it's from, but I'll summarize it. 40-year-old couple with $1 million, all in 401k pre-tax. They have the option for Roth. How do you start deciding how much to divert, if any, to the Roth, also knowing there's a Social Security and pension in the mix? The answer is it depends, of course, but like what kind of process, what things are the inputs here and helping decide this?
Yeah, this is a great question. So this really comes down to, I know it's somewhat of a debate, sometimes even within the group, is Roth versus traditional, like what's better for me. And I know sometimes we share, there's a article, maybe I'll share on the video too. I wrote an article about kind of not just the differences, but how to decide if it's which side is right for you at different areas. But most people, when they think about Roth versus traditional at any stage, whether you've already contributed and want to convert, they're really thinking about what's my current tax rate versus my assumed retirement tax rate, right? And they try to keep that very simple. But I always say that Roth versus traditional shouldn't be based on your current marginal tax bracket, actually, or your age. For example, I've heard a lot of people say, hey, if you're young and you just started working, you're not making very much money, you should go Roth, right? And like, you would say, well, yeah, they're at a low tax bracket today. And, like there's a lot of years, for that to compound. But there's a few things you have to consider. You have to understand that person's. I'll just use this person as an example who made the comment. You're 40 years old. One thing here is, are you planning for a traditional retirement? Like, for example, this person who's 40 and has $1 million. If they're going to retire at 45, right? I would tell them to keep contributing to pre-tax, most likely, because they have a lot of time to unwind that and have, but here's the thing. They have a lot of time to unwind that. But even at age 40, there's been some accumulation to get to that million. Really, what does their their taxable brokerage assets look like? Do they have the ability and the flexibility to do those Roth conversions, right? Because you have to pay those taxes from somewhere, and you certainly don't want to take them out of the pre-tax account before 59 and a half. So it ultimately depends on your personal, your time horizon to retirement. You have to think about your current income, future income. You have to think about things like filing status. I know we talk about the widow's penalty and really the effects of possible a single filer versus a married filing jointly, all things that come with that. I think so there's a couple more. I'll just quickly say that I wrote down in terms of that question. Actually, it's really so current and future income sources, current and future expenses, state tax location. Right? Some people say, "Hey, I'm in California. It's pretty brutal here. But maybe I'll retire and move to Texas with Cody with no state tax." So filing status, income-based healthcare, right? So not just IRMA. We talk a lot about IRMA, which is the Medicare premium adjustments, but also the marketplace subsidies. For example, if the person who commented, they're 40, if they're going to retire at 45, they might have 18 months of COBRA available to them. But what are they going to do now from 45 to 65 in terms of healthcare? And as you see, a lot of the healthcare subsidies, or really the healthcare subsidies for the marketplace, are based on taxable income. So can we unwind all that pre-tax assets really in a really smooth way, but still possibly qualify for some of those subsidies along the way, ultimately keeping more of that money you've really had the discipline to save?
Yeah. My other very unquantifiable comment about whether to do traditional tax deferred contributions or Roth, if you're sometimes it's kind of glaringly obvious. If you're making $1 million a year now and you're retiring in a year or two, no, now is not the time to do conversions. Wait a couple of years. But if you're on the fence and no matter how much you kick around and numbers you look at, you're like, it's not really clear. I don't think people will regret over converting, and I don't mean convert hundreds of thousands of dollars more than you think you should, but I don't think the future you will look back and be like, man, I wish I didn't have as much tax-free income as I currently do, right? But I'm more inclined to say people will feel the opposite, the other way about having too much tax-deferred money. Fast forward 20 years, make, oh man, I wish I had more Roth money now.
Right.
So this isn't specific advice, but if you're on the fence, maybe lean towards Roth. But like Cody said, there's lots of things you need to run through and consider.
And so with that, so this question usually happens with people who have. Thing is, if you're 40, right? If you're 40 and already have $1 million in pre-tax money, I'm guessing that you probably have a pretty sweet, you're probably making pretty good money to be able to push that much aside. But one thing to keep in mind is that it might make sense. So in terms, you talk about the order of operations, it might make sense to consider, if you're 40, it might make sense if you have the capacity to save this, to put in your 19.5 to your pre-tax 401k. And then here's the deal. Look at your 401k to see if they offer after-tax non-Roth contributions, which we call the mega backdoor Roth. I think you might have done a video about this as well. But the thing is, you might be able to do 19.5 to cut, let's say that you're in the 24, you're making a lot of money. You're in the 32% bracket right now. And so the 32, so 19.5. So, you save $6,200 in taxes this year by doing 19.5 pre-tax.
Yep.
Then you can fill up, including the employer matching or non-elective or profit sharing contributions, up to $58,000 this year if you have that option within your 401k. So not only did you save more money, you didn't get the tax advantage, but you're going to get a lot of more money into your Roth. One thing is that Roth grows long-term tax-free, but you can also, even though it wouldn't be the priority, you would have access to those contributions. You can have those original contributions to Roth, you can have access to, before 59 and a half. So that, and then of course, the backdoor Roth IRA, because you're probably making too much money to contribute directly to a Roth IRA.
Yeah, that's good if you want to beef up your savings. I guess original question may have been for the contributions you're currently making, how to decide could you or should you divert some to Roth? But
well,
I think you touched on the points there.
Yeah, a big thing in like financial independence communities is what we call Coast-Fi or Coast Financial Independence, which is once you've reached the ability to, if I save no more money, I'll have enough saved to like have traditional retirement covered. Really, every extra dollar you save really either pushes that date forward so you can retire early, or gives you more money to spend in retirement. So if you already have like if you've already met your traditional objective to retire, and you want to, let's say you want to retire at 60 and you've already kind of met that goal, like then it really makes sense to start thinking more about flexibility than all the tax advantages. Say, hey, I've already saved for my traditional retirement. I'm going to put that money into like after tax, like taxable brokerage accounts, so that I have a lot more flexibility moving forward.
Taking that out, yeah. There's a handful of questions. We will maybe just save till the end and we'll just rip through them. But one other thought I have, I think is pretty important in difference of accumulation versus decumulation is investment, kind of willingness and ability to take risk, how that typically needs to change. So for example, if you're 30 years old, you have 20, 30 more years of earnings ahead of you. If and when the market drops, like it did in early 2000s, like it did in 08, 09, like it did, albeit only for a short time last March, which still blows my mind how it came back so quick, but whatever. Those are phenomenal times to put more money in. Like dips are good. I get excited as an accumulator personally. I get excited when things drop. It's like, stuff more money into it.
Isn't it funny how like before the dip, like you didn't think you had any money, like extra money you could save. When a dip happens, you're looking for coins. Dude,
I got $18 here. Right.
But I do see what's funny in that same thing about the dip. Some people they say, I have all this cash sitting aside for this opportunity. Like I'm waiting for the next dip. Right. And those, people who, even though, yes, getting in on the dip is great, but like, historically waiting on the sidelines, like waiting for that dip historically is not paid off.
It doesn't work out. I'd agree. You don't try to time the dip, but if and when the dip occurs, and
that's
I don't know how to define the dip, but you know it when you see it, right? When things are down 20%, you're like, oh, this is a dip.
Yeah. Convert. That's a great time to convert too. Because you can even convert shares in kind if you're going to plan on holding it.
More bang for your buck. But so as an accumulator, dips are good. When you're consistently putting money in, that's called dollar cost averaging, basically, if you want to think about it that way. You get more bang for your buck. When you're decumulating and you are actively taking money out of your portfolio, you're no longer adding to it. Market dips are bad. Then dollar cost averaging works against you, because as prices are dropping and you're taking out a static amount of money, you're taking out more and more shares because they're at depressed prices. That's called sequence of return risk. That is a term that's unique to distributing from a portfolio. So the planning around accumulation is, when you're young, you're constantly saving money. Market dips are good. Pile into the risky stuff. When you're decumulating, markets are bad. I don't want to. Again, it depends. If you're saving your money for your heirs, then sure, maybe you still have a long time horizon, whatever. But if you're actively distributing, that's when you need like buckets, or you need your safer, stable bonds to pull from. There's more tactical management of your portfolio there, as opposed to just dumping in.
So that's exactly when we talk about. Really, I say like give every dollar a use by date, right? When you go to the grocery store and buy something, it's always like, I got to eat this by next week, but this cereal is probably going to last like, a few months. Or there's canned goods, you could think of that as that's your Roth IRA money. Like, you might not even eat that at some point. Maybe you'll just pass the canned goods down to your heirs.
Right.
But you can start thinking about your money. And when you start thinking about when you need the money, really, I say this when people say, how should I invest my emergency fund, right? The time horizon for an emergency is anywhere between like moments notice, like right away, to like 6 months or more. So thing is, moments notice, you probably don't want that money even in like, bond funds, something that has any volatility that you need tomorrow. But, part of your emergency fund that you might not need for 6 months. Some people have even like a 2-year especially people in retirement, they might have kind of like a 2-year kind of stable, liquid account. Like that's a place to like focus on liquidity and stability for money you're going to need in the next few years. And that's why, it doesn't necessarily make sense to do that outside of an emergency fund when you're 30, right? But it does when you're retiring.
Yeah. And the other complexity, as people in the group probably figured out, is it also depends. Just like you can't look at articles that say you need $1 million by the time you're 40 to retire. No, you have to look at your other sources of income. Do you have large pension, Social Security? If so, do they cover most or all of your expenses in retirement? Mm-hmm. If that's the case, you don't need a lot of extra liquidity, because you're not, maybe it's for a big trip or you get your roof replaced. But it's not like you're consistently pulling 50 grand a month out of your portfolio to live on. Maybe you're only pulling out 5 because you have pension, Social Security. So your needs for a bigger pot of cash, bigger pot of safer, stable, liquid stuff is going to be smaller than someone who's not in that position.
And yeah, you make a great point about when you see those articles that say like how much money should you have in retirement, like by the time you retire, right? And the metric, it's like $1 million. And I always, when I show people a balance sheet, we actually don't even look at like the net worth number, right? We look at really the tax location of the assets and the account titling to make sure things are going to pass outside of probate and things like that. But I always say, thing is, a net worth to one person might mean wealth, to another person means poverty, right? So like
it's relative.
Net worth, like in and of itself, like actually doesn't mean anything if it's not aligned with a personal objective, right? So that's why it's important, again, going back to like really thinking about money in terms of it's a tool, and its job is to work for you, right? Not to work for what the other guy's doing or what the article says. So coming back to like, when am I going to need this money and for what things?
Have the use by date. Exactly.
The use by date. Yeah.
Any other? There's some good questions flowing in. I mean, we can just turn this into a free for all for questions if people want. But any other accumulation, decumulation things you wanted to hit on from the accumulation perspective?
Yeah. Let me. Me, I'm a preparer, taking notes.
Oh yeah.
So I think the last thing that I said. The HSA. It's never too early to plan for long-term care. Who is our long-term care friend who came?
Carrie.
So Carrie would love that I say this, is like, it's never too early to plan for long-term care. And as an accumulator, like there's you might hear, traditionally like, hey, when you're in your your mid 50s, start thinking about long-term care, right? Like there's opportunities to plan for the seriousness and also the likeliness of needing long-term care. The second thing is home equity, right? There's a big debate on whether or not you should like pay off your mortgage versus invest the rest. And, there's a lot of pros and cons to both. And again, it's both a quantitative historical investment decision, but it's also qualitative. It ultimately, like, again, aligning with your objectives. But one note here I have is be careful not to lock up your net worth into a house, into your your primary residence, unless you have a plan to turn it from an asset into an income source. So I see this a lot, especially with retiree, somebody who's going to retire and they're going to buy a new house. They're going to sell their house, like maybe downsize. But what they do is they sell their house, they get all that cash, and they don't evaluate what exactly what their income needs are that cash be used for. They dump it right into the new house, right? Okay. And this isn't saying this is always the wrong way or right way to do it, but they put it in this specific client. They put it into that new house, but then they have this great new house, but they don't have a lot of flexibility to like really maintain like their desired lifestyle within the house. All their money's locked up. And again, it's not money that, and the house, again, most primary residences are more of a lifestyle decision than an investment. Right. So that's the last note I had before questions.
Yeah, that's a great point about home equity. Even if you don't take, so if you buy $1 million house, take out a $900,000 mortgage, you don't have a lot of equity. It's only $100,000. But even if you did pay out of pocket for the majority of that million, yes, you have more equity, but you have that much less liquidity and other disposable / usable assets. So think about, and don't be house rich, cash poor. Is that saying?
Yeah, and one thing I have I'll share it too. I have a 15 versus 30 year mortgage calculator to really figure out like not just how much interest you're paying, what your monthly payment is, but what is the opportunity, like how much are you paying for the opportunity to turn that 30 into a 15, right? It's really hard, especially if you're retired and don't have any like stable income sources, to turn a 15 into a 30, right? But you should just start thinking about, again, the flexibility of your money and saying, maybe I can, maybe turn a 30 into a 15. Really, again, just going back to like, know the pros and cons of both or multiple options. And then again, come back to like, how does this align with my personal objectives and values? And I think that's how you can start doing planning like for yourself.
I think that's a great takeaway, and coincidentally, a great way to kind of wrap the formal presentation part. Personal finance is more personal than it is finance. I've heard that from Rick Edelman. He's got a big podcast, and he's the founder of Edelman Financial Engines. I don't agree with a lot of what he says, but I really, really love, I'm stealing it from him. Personal finance is more personal than his finance. So make sure your financial decisions align with your goals, your values, the things that really mean something to you in life.
Right.
And then the planning around it, there isn't right answers to many of these things. It depends. It is making a decision, the pros, the cons, just knowing that if you choose this, it's going to impact this. If you choose that, it's going to impact that. So don't get too hung up thinking that there is a single right decision to be made. Sometimes there is, but oftentimes there isn't. Right. Just know the impacts of the decisions, and that's kind of the best you can hope for, both accumulating and decumulating.
Now, what I'll say about that is that I think that my goal, my role, and my goal, and Andy's as well, is that sometimes it can be really kind of annoying, right? When you ask a question, and somebody just says it depends. Like you should probably consult a fee-only financial planner. Like it seems like maybe like a conflict of interest to say like, hey, well, kind of the traditional advising, the traditional advisor, like kind of figuratively what they do is they kind of like push you down into a well and say, I'm the only person with a rope to help you out. Right. So like, anytime we say, or people in the group say like, it really depends, right? That's actually a good opportunity to like, even my what I like to do is instead of just saying it depends, I'll kind of follow it up with like, here are some additional questions to ask, or here are some additional resources. So I think Andy in this, this is really what, Andy's created here is a way to help people think for themselves, but also have some factual information along the way. So I think that's really helpful. Thanks, Andy, for the group. I'm sure everybody's grateful for that.
Thanks, Cody. And quick shout out to Cody. So you were a speaker at the Financial Planning Association externship. 2 people loved you there, Cody. I guess you killed it.
2 people love me.
Yeah, at least 2. All right. Hopefully more than 2. Okay. Let's start hitting some questions. So Dave Fultz, I think we touched on this kind of indirectly, but how do you help people balance the fear of running out of money versus underspending and having a huge pot of money? It's personal preference. As I touched on before, some people means more to them to not see their nest egg deplete than it does to live a more comfortable, fun, enjoyable life by other people's standards. So it's having the conversations. It's finding out what's important to you. What are your pain points? And help you, if it is something, if your fear of spending money is some deep rooted trait that you inherited from, a Depression era parent or grandparent or great grandparent or whatever, that might be hard to shake, right? You may not be able to get over it, even though we try to help and, give you the options and help you think through the decision.
Well, one thing I'd say there, this seems to really help, especially when you're doing like any type of financial planning. And I specifically wrote here, you do not have to make all of your long-term retirement decisions right now. So there's this, it's really easy because we're such long-term, like there's a lot of wise long-term thinkers in the group. And, when people talk about the fear of running out and also like having a huge pot of money, again, it's important to start with the end in mind, but not always keep your head there, right? So it's important to plan for the long term, but then you have to step back and, plan is a noun, right? You make this plan, but plan is also a verb. It's something where, when we talk about Roth conversions, like this isn't something where you decide, okay, I'm going to convert up to the 22% bracket. Like, like that's my goal. Like I'm just going to do that, right? You have to look at these decisions on an annual basis. So that whole fear of running out of money or having a huge pot of money at the end, I think it's a really important to like really step back and like be more focused and think about, come back. I've heard that, thinking about the past is the definition of depression, and thinking about the future is anxiety or worry, right? So I think any type of worry, that's usually looking ahead, have anxiety about the uncertainty and the unknown. There's a Carl Richards, you might have seen the two circles, the overlapping
concentric circles. Yeah,
exactly. It's like, like the things that matter and the things that are in our control, where those two things meet is where we should focus. And I think anytime you have a fear, I mean, it is important to know kind of like, hey, am I on track? Right. But typically the fear of running out, or the fear of not having this big pot of money at the end is really too forward focused. And so I think it's always important to make decisions that really are on an annual basis, but also only based on what you currently know. Just a quick note, there's a lot of talk about future tax legislation, right? They say, hey, what, this is like, this might happen. What should I do? Right. The only thing that we can do is use the information that we currently know. Right. Because as you know, there's a lot of stuff that makes it through, and there's a lot of stuff that doesn't. A lot of stuff will make it through that's kicked out, maybe 4 years later. Right. So again, make all of these financial decisions on an annual basis and plan along the way. I think that will provide a lot of comfort and avoid a lot of automatic thinking about the future.
Yeah. And Cody made a great reference. There's this guy, Carl Richards, who was an advisor. Now he's just kind of like a coach, mentor, whatever. He's famous for making a Sharpie and making some crude drawings, but very impactful drawings. One of which Cody mentioned is picture two circles. One is things that matter. One is things you can control. This is where you focus, where these two circles overlap. Things that matter that you can control is what you focus on. You don't waste your time on things that don't matter and or things you can't control. You just, the intersection of the two. But anyway, keep that in mind, everyone. I thought that was a great reference.
And I'm a big fan of like the cognitive behavioral therapy kind of stuff, and really thinking, typically this type of anxiety comes from automatic thinking. Like I always tell people, like, don't believe everything you think. Right. That's a very interesting term, but like really a lot of the thoughts that you have about especially fear and anxiety are actually things that may not actually exist. Right. So again, like really keeping your narrow focus helps.
Just super quick. I'll hit this one and move on. Someone asked, can you take $10,000 a year out of your 401k and gift it without tax? Someone else responded, no, you can't. It'll all be taxable distribution, which is true. To which someone else responded, it's only tax-free for over 70.5 and do a qualified charitable distribution. That only applies to IRAs. You cannot do QCDs from 401ks, at least not currently. There is pending legislation called the Securing a Stronger Retirement Act or something that's proposing this, but that who knows if that'll happen. So this is only for IRAs.
Yeah, a quick note there also is that another way for it to be like not technically tax-free, but like effectively tax-free is if you are itemizing already and you're, if you're able to gift that to charity and itemizing your deductions, it will still be, the distribution from an IRA or 401k, it'll still be included in taxable income. But then as a below the line deduction, you're kind of like, you're kind of washing it out by taking the income and then reducing it.
Or it's an adjusted gross income, but not taxable income.
Right.
All right. So, okay. Just looking over now. Other comments, questions. What is this? This one I don't really know. Do you know, Cody? Is there a moratorium on filing against your HSA? So taking reimbursements out of your HSA for your kids' doctor's visit. So I guess the question is, your kids are 12 now. How long can you wait to pay yourself back out of that HSA?
Well, the thing that I know is that they have to be. I believe they have to be claimed as dependents on the tax return for you to take a distribution for them. But one thing about the HSAs is people say, hey, I can reimburse myself, but you can only reimburse yourself for expenses that happened while you were covered by HSA, eligible high deductible health plan.
Correct. Yeah.
So I'm sure there's a lot more to this question, but just kind of the basics.
I don't know this for a fact, but to be safe, I would assume, yes, that the child still needs to be dependent on your tax return in order for you to make distributions from your HSA.
And the thing is, your child's most likely going to be like a part of your family high deductible health plan and your family HSA. So yeah, if the kid's a dependent on your tax return, that should make sense.
Quick one for you, Cody. How can you automatically set up your retirement accounts to send you a paycheck twice a month when you're in retirement?
Yeah, I think this ultimately depends on the custodian. The best thing the number one thing I would do is actually call the custodian. I'd call Schwab or Fidelity or Vanguard and say, what's the easiest way to do this? And sometimes they can even like do it for you over the phone. But I mean, so traditionally, at another firm, I actually did these move money. I actually like facilitated these requests. One thing to know there is that if you are a DIYer in setting this up, you do have to make sure you have liquidity in the account and that you're not having, you have to understand that for example, if you sell a mutual fund, there's they're settling, there's T+2 or two, all those things. You have to wait for money to settle before it can be sent to your bank. So understanding the timing, I think what I would do is just call the custodian. It's funny, I called Fidelity and Vanguard the other day, and they answered within 30 seconds. I was like, this is a good time of year to call. So
wow.
go ahead and call them now while they're not busy.
Yeah. Do you know, this may be better for Brian Williams, the 401k guy in our circle, but Alan Thomas can't get a straight answer from his 401k provider about whether or not he can pick the funds to withdraw. So meaning he has some after tax, he has some pre-tax, he even has some Roth, let's say. My understanding is it's generally you get pro rata distributions. I've heard other folks say, nope, they can choose which account. What's your experience been?
Yeah, well, so one thing I'd say here, this is actually, especially if you've already left. So instead of just funds for a moment, I'll talk about like, the tax characteristics. So if you had a Roth 401k, right, but your employer had a match, that employer is going to go, you're just going to see it as one big 401k. But really, record keeping wise, it's like there's a like a pre-tax bucket and a Roth after-tax bucket. But once you've left that employer, it can, we talk about risk capacity. After you've left an employer, that's another reason it might make sense, not always, but it might make sense to roll that into to respective Roth and traditional IRAs so that you can actually control the funds within each of those tax characteristics moving forward. Yeah.
Assuming you want to or need to roll it over, but for whatever reason, you have to or choose to keep it in your 401, then yes, I think the only way is to hopefully get a straight answer from your plan administrator, right? Outside of that.
Yeah. My initial thought is that when you take money out, like, it's going to be the record keeping. I mean, it's getting more advanced. The record keeping is becoming more advanced, but they're going to be just like, oh, you need this much money, we'll make it happen. But like, good luck trying to take control over every dollar and where it comes from.
Yeah. I'll take this one, I guess. Is there a tax advantage for healthcare expenses to have money in tax deferred accounts to draw from as opposed to taxable account? So yes, I guess the question ultimately comes from why wouldn't you want to convert away all of your tax deferred money, or what are the benefits of leaving yourself some tax deferred money? Mm-hmm. And yes, this is one of the big ones, is potential healthcare expenses down the road, especially at one extreme. If you have a long-term care event where you're pulling out $100,000 a year for multiple years, let's say, then yes, if you pull out $300,000, or let's just keep 1 year, you pull out $100,000 from your tax deferred IRA in 1 year. Yes, that's $100,000 of gross income. But guess what? You're going to have really large medical expenses, the vast majority of which will be deductible. So from a taxable income perspective, most of that $100,000 of gross withdrawal you took will be nibbled away by the deductible tax expense, itemized deductible tax expenses you'll have, healthcare expenses you'll have. So yes, that's one reason to leave yourself some tax deferred money.
So yeah, one thing there is people ask me, hey, like, I want to convert everything to Roth, right? But one thing that we have to keep in mind, when we see the marginal tax rates, we see like the 10, 12, 22, whether 24, 32, all, going all the way up. But what you don't see on there's effectively a 0% tax bracket, marginal tax bracket. It's called the standard deduction, right? Mm-hmm. So sometimes it actually makes sense to have some pre-tax money still. One, so that you can take up to the standard deduction, technically tax-free, at least on the, federal, state has different, standard deductions. Yeah. I'll stop there with that one.
Okay. Yeah. So I was, I'm reading this kind of long comment, but I get the gist. So I'll try to sum it up. In decumulation, you're currently reinvesting dividends you get in a normal brokerage account. Why would you divert them from being redivested to cash? Because it sounds like the assumption here is that if you take it as a cash dividend, you have to pay ordinary income tax on it. Whereas if it's reinvested, it could become a quote unquote qualified dividend, which is treated at the lower long-term capital gains tax. It's not the case. Whether you choose to get it cashed out or you reinvest it, when the dividend is paid, its tax status is determined at that time, period. Whether or not it's qualified has nothing to do with whether you invest it. Qualified just means how long you owned the shares prior to the dividend being paid, and if it's a U.S. company, basically. Yeah. So it doesn't really matter whoever posted this.
And if you're looking at your account, if you look at, you can actually look at their lots. Like if you look at the cost basis tab and look at your lots, anytime you reinvest dividends, you're actually buying. You can actually see like a new lot. It's actually a repurchase. So yeah, that's a good point. That if you get paid, dividend interest income in a taxable brokerage account, it's taxable when it's distributed from the fund company, not necessarily like taken out of the account.
Yeah. Let's take this one. RMD withdrawals are calculated at the end of the year. Great. Oh, great. So you know what that amount is, but if the account grows during that year above what you withdrew, do you get penalized for taking too little? So I guess the question is, account
generally, do you get penalized for not taking their full RMD? Or
no? I think the question is, so as of December 31st, your account balance was $100,000. Your RMD is 4%, so you have to take out $4,000. I guess the question is, if you don't take out your RMD until later the next year, your account since grew to 150,
right,
and you only take out $4,000, are you penalized for not taking out a larger amount because your account has since grown?
No, it's just based on the December 31st account value of last year, regardless of what happens moving forward this year.
Yeah, and even if your account tanks, if it goes down to $40,000 from 100, you still need to take out that 4,000, unfortunately.
Right.
And that's part of the reason why they waived RMDs last year, because of the CARES Act. Because at the time they crafted that legislation, the market had dropped like 30%, stock market. So they didn't want to force people to take out, static amount of RMDs when their account balances could have dropped 30%. So they waived it. Now it ends up the stock market had a massive, rebound for the year. But anyway, it
was really exciting to actually see people putting back. Just a quick aside, people are putting back their RMD, but this is what's really interesting. Some people gave their RMD as a qualified charitable distribution, a QCD. They gave it to charity, and then I'm like, do I ask charity to give it back? Like, if I want to put it back in, it's like we won't deal with that. Just let the charity. The charity needs it more now than ever, probably.
Exactly. Yeah, definitely. I don't know if this is a response to another question. Or this was a fresh question, but what happens if a person does end up running out of money? Frank, it's a fantastic question. I'm surprised people have. I shouldn't. Sorry, I'm surprised people haven't asked this before. That's why I'm laughing. Like, it's almost such a painfully obvious question that I haven't heard before. I don't know. What are your thoughts, Cody?
Well, what's funny is that financial advisors aren't taught what to do,
right?
Which is kind of funny that we aren't. I guess we're trying to train to work with people who have wealth traditionally, but I think that really goes into the state, going on really like the subsidy state level, federal level for. Of course, running out of money. Like, what does that mean, or like at what age? Running out of money, maybe I have talked with some people who don't have any Social Security, whether citizenship issues, but I think that's something where hopefully you don't wait till you get to the point to seek help, right? I would say there is that's why planning is so important. Like, start working with a planner. I'm not plugging myself here, but start working, especially if you have these concerns. Like, consult a professional who actually not just any other professional, but somebody who actually understands like the benefits on the state and federal level if you're actually worried about this.
Yeah, and from a retirement income planning perspective, running out of money means running out of portfolio assets, investable assets, right? So in putting together a plan, you want to, in a perfect world, you'd have as much as possible sources of guaranteed lifetime secured income, Social Security, pension, and or annuities that you bought. I say this with an asterisk, but those three things shouldn't stop. They'll last as long as you do, maybe even with inflation increases. So there's just some fanciness to income planning where you want to figure out what are your sort of baseline expenses you anticipate having. Ideally, pair those up with sources of guaranteed income, Social Security, pension, and or annuity, so that if and when your portfolio, your investable assets do deplete, you're not completely out of money, because you'll still have these monthly paychecks from Social Security, pension, or annuity that hopefully at least cover your basics so you can live a dignified life. Not glorious, glamorous, whatever, but not complete squalor either. So yes, it is possible to run out of money, but hopefully you still have a decent income floor. That's kind of my thoughts about that question.
Yeah, so I have worked with a client in the past that had very, very limited assets. His Social Security, I think his total income for the year was about $10,000. And again, this comes back to lifestyle. I know that you have to figure out first of all, like, do you have real estate? Do you have personal property that you're worth, that you may consider either selling? And really that comes back to, like, really you would have to change your lifestyle ultimately, hopefully before this occurs.
Yeah. This is a fun one, so I'll I'll put it up. Heard me say I don't agree with much of what Rick Edelman says. Who do you agree with and why? So I agree with a lot of what he says. It's not everything. That I think that may be my comment. If it wasn't, I misspoke. Dave Ramsey, on the other hand, I think I disagree with more than I agree with him. But anyway, people I do like, Jim Saulnier. He has a podcast called Retirement and IRA Show. Now I'm a little biased because he and I are the same sort of thought process with retirement income and tax efficiency. So we're cut from the same cloth. That's why I like him. But he's agnostic in the sense of he doesn't bash annuities. He doesn't pump annuities up. He's like, these are all tools. Whatever works best for you in your situation, that's the right answer for you. So him I like, super technical, super sharp, and kind of witty. I don't like anyone, or I have kind of mental block against anyone who is flat out just insurance, flat out just like the opposite side of the pendulum is Ken Fisher. His tagline is literally, I hate annuities and you should too. Well, that's the dumbest, most boneheaded comment. He's as guilty of being biased and unfair as, people who only sell insurance and will promote that to anyone who listens. Yeah. So where am I going? Now I'm kind of ranting, but yeah, Jim Saulnier, Cody, anyone who seems like educators at heart, who doesn't have, they're not selling a show that they're promoting. They're not selling books. They're not selling a product that's commissionable, or at least that's not their sole compensation. I don't know. You can just kind of tell.
Yeah. So my opinion here is that, sometimes it's like, you know what you want by knowing what you don't want. I would say anytime you see, especially like social media influencers or like big, people on the radio or big TV shows, if you hear somebody say always do or never do, or, these are the top 10 things, like, usually if they're approaching you in a very clickbait, behavioral, emotional way, it's most likely not in your best interest. I would ultimately find people who really, it's funny. So Dave Ramsey specifically says, like, work with somebody who has a heart of a teacher, right? Thing is, find, when you're looking for financial information, find the people who are creating that content, they need to have a heart of a teacher as well. So find those types of people. I know. Yeah. So we're both, specifically passionate about this stuff, but I'm sure there are more out there that will probably share, and hopefully they'll become members of the group.
Yeah. I also like Roger Whitney a lot, another podcast guy. Now, in full disclosure, I'm a coach in this membership group he put together, but I joined that because I liked him and what he does and how he does it, not the other way around. So he's also product agnostic, kind of liberal thinker, no dogmatic advice that always do this, always do that. So liberal thinker meaning like he's open to different ideas, not political spectrum. Not making this a political thing, but anyway. All right, I thought that was a cool question. I didn't look at this yet. Let's see. We'll let you take this, Cody. I have some underperforming equities, but a lot of capital gains in my taxable account, plus money that needs to be converted to Roth, my pre-tax account. How do I decide between capital gains or conversion to still keep income tax and IRMA Medicare surcharges down?
Ooh, I just had I just had a good conversation about this with some other planners. So there are a few things here. So first of all, the tax characteristic, right? So, pre-tax accounts, that's all going to be ordinary taxable income, which is taxable at your marginal tax rate, whatever tax rate. I guess, it could be effective if that's your only source of income, but just say your marginal tax rate is how that's taxable. Whereas your capital gains, I'm assuming if you have, typically if you have a lot of capital gains, it's long-term, which means you've held it for over, more than a year and a day. So that's taxable at the favorable capital gains tax rates, which is at either 0%, 15, or 20. Plus, if your income is high enough, a married filing jointly, if your income AGI is above, or not just AGI, but your income's above 250,000, you have the 3.8% net investment income tax. So at the end of the day, really you're being taxed higher on the conversions or on the pre-tax money, but ultimately you're converting because you want to avoid that ordinary income in the future, right? Whereas capital gains, so they're favorable today, but here's the thing. Depending on tax legislation, capital gains in this moment are still more favorable in the long term because of the step and basis. I know this is, again, things in our out of our control. I've seen the case for both, like saying, okay, like let's let's realize these long-term capital gains now, especially if you're holding things that you don't want to hold moving forward. One thing that kind of hits me with this comment is some underperforming equities in terms of, underperforming. I kind of have to define like what the expectation of what that equity is going to be do moving forward. But more importantly, like, is that equity aligned with your personal like, should that equity even be, is it aligned with your personal objectives? Because that might end up being an equity that actually makes sense to hold moving forward rather than just sell.
To bring this comment back to Rick Edelman, one thing he said that I really like, that I never thought of from this perspective, is thinking about, you have a position you've had a long time, you may want to sell, you're not quite sure, you kind of have some personal attachment to it because you've had it 30 years, whatever. He said, forget that, forget the past. If you were investing new money today, would you buy this stock today? If the answer is no, then there's your answer. Get rid of it. Now, there's tax consequences that you have to keep in mind, but don't get hung up on the past. Never get emotionally tied to financial investments. Always approach it. If I was investing new money today, would I invest in this position today? If the answer is yes, then sure, then keep it. If the answer is no, there you go. You probably shouldn't have it.
So one more thing, just I talked about the income, like the federal income side, income tax side, but the IRMA, both of those. So realizing a gain and converting, those are both seeing the same for IRMA purposes, because that's based on not how it's taxed on the bottom of the tax return, but modified adjusted gross income.
That's a great point. For adjusted gross income, it's the gross amount of gain. It's not like the reduced actual taxable amount. So whoever asked this question, they're going to impact the same, actually. How much time you got tonight? I don't know how many more questions there are, but
I'm good. Yeah, just keep chugging along as long as people stay.
Go until Thursday. All right. Can you remind us of the pros of leaving money in the 401k versus moving it to your individual Roth or traditional IRAs? Thanks in advance. What do you think?
So a few things to think about. I know in terms of investments, you can think about sometimes the fees are actually lower in a 401k if you have institutional funds. I know Andy's mentioned the stable value funds, which is kind of cash equivalent with a little bit more higher interest that you could probably get elsewhere. Another thing, it's more rare, but if you've heard of NUA, net unrealized appreciation, that's what it's called, right?
Yeah.
If you have employer stock within your 401k, like, don't do anything yet. Like that's one of those times where you want to really measure twice before you move money from a 401k to an IRA. For the most part, the IRA does provide a lot of flexibility. One thing to keep in mind with a 401k in retirement, let's say that you are, you're just in the 12% marginal tax bracket for, in retirement. When you take money out of a 401k, you have a mandatory 20% withholding on that, right? Regardless of if you're going to owe that tax or not. If you take money out of a 401k, there's mandatory withholding. Versus an IRA, you can elect even 0%, and sometimes even 0% on like the state tax level. You have more flexibility in IRAs, but that does not necessarily mean it's better to just shove everything there as soon as you leave your employer.
Yep. And the other big possible benefit is Rule of 55 withdrawals. So if you retire, have a separation from service in the year you're 55 or older, but not yet 59 and a half, and therefore, because you're not yet 59 and a half, you typically can't take money out of tax-deferred plans without a 10% penalty on top of taxes. But majority of 401k plans, technically, I think it's all, because the IRS kind of mandates it. Anyway, the plan should allow you to take distributions from that plan between ages of 55 and 59 and a half without 10% penalty. Once you roll it out to an IRA, you lose that ability.
Yeah, one thing with that, you mentioned 401k. A 457, right? Depending on, there's different types and stuff like that and different plans, but 457, if you have the ability to take money out before 59 and a half without penalty from a 457B, that's one case it wouldn't make sense to try to be moving stuff around. Again, that's ultimately like, know your plan before you move money.
And there's no age limit on that at all, right? Or is it 50?
The 457 is any age without penalty.
Any age, okay, right.
Because it was built for all those government people and stuff that they only work for a few years and then they.
Oh boy, let's move on. Mavis loves the Andy Cody partnership, and the Andy Cody partnership loves Mavis. Thanks,
Mavis. This is the to and through retirement show. Yeah, that's what we call
That's right. So for those of you who don't know, Cody and I had kicked around the idea of tag teaming, doing a podcast. We're going to start this year, and just kind of, I don't know, life got busy, tax season, whatever.
And I bought the microphone. I mean, come on.
He did. That's a microphone. But we're going to do a podcast called To and Through or something like that, where it was going to be each week we would tackle a certain retirement or financial planning topic. Cody would approach it from the to retirement planning and thought process. I would pick up where that leaves off and approach it from the through, how you plan and what's different about it, planning through retirement. I thought it was a cool idea. Never really didn't get off the ground. We did have an intro call. We discussed hardware to get and talked with the producer, but life got busy and we stopped. Anyway.
But then again, but that's the thing. We don't have to make all our longer term decisions right now, right? Like we take the decision to a podcast on an annual basis, and we figure out, maybe someday.
Yeah. June, you may have tuned in late, but June asked, follow up on HSA reimbursement. Can you reimburse yourself for children's medical expenses incurred while they were covered by your high deductible plan 30 years ago? Cody says, okay, do it, June. Is that what you meant, Cody?
So, yeah. And another thing to keep in mind with HSA, it's a little different from like 529's education funding, where like HSA is more of a, it's not necessarily the IRA like trust you, but like when people talk about like keeping, like I'm going to keep my receipts in my Google Drive, or keep physical receipts for everything for 30 years, like that's a lot to handle. But ultimately, all this debate is more about like in the case of audit, right? More than like you don't have to like send that receipt to get the money on the HSA.
June, to answer your question, it looks like other people did, and we touched on it before. Neither of us, we could be wrong, but neither of us believe you can do what you're asking. I think your child still needs to be a dependent on that year's return for you to take a distribution in that year. But
this sounds like so they're not paying for a medical expense 30 years. Like it sounds like they're reimbursing themselves for an expense that happened while the child was covered by the high deductible health plan.
You think you can do that? I don't know. I thought you could. I know you can for yourself. You can reimburse yourself for expenses you had decades ago, assuming you had HSA at the time. But you think that's the case for children as well? Like that were dependents at the time of the expense, but they're not now?
It's really, it ultimately depends on when so if I have a kid and, we go to the doctor, and I save that receipt that I paid out of pocket, at that point, he was covered by my high deductible health plan. And he was, we had a family HSA at that point. 30 years later, I can enter that receipt that has the date of when he was covered. So it's
okay.
Yeah, I mean, this is like more of a what if than reality. But as long as they're covered under the plan at the time of
the expense was incurred.
Yeah, like not at the time you take the distribution, but the time the expense was incurred. Yeah.
Interesting. See, this is the stuff I in my practice, I usually don't deal with anyone who still has dependent kids on HSAs and like college savings. I mean, I'm 43. I'm living, having kids, saving for college, houses, whatever. So I'm familiar with some of that stuff. But from a planning professional perspective, I really don't have interest in working with people in this stage of life, whereas Cody does. So
hey, one more thing about HSAs. As soon as you become a single filer, I know that's like a sad thing to talk about for married couples. Once you become a single filer with an HSA, start thinking about distribution for medical, because we talk about the inheritance rules for HSAs are very brutal. You want to say something about that, Andy?
Yes. And interesting. Actually, someone not called me out, but brought to my attention something I wasn't quite aware of, that so the inheritance rules are if you're married and you have an HSA and you die, you can leave it to your spouse. Your spouse can continue to use it completely tax-free for qualified medical expenses. So it's still functionally HSA, just the same in his or her hands. When the spouse dies and leaves it to someone else who's not a spouse at that point, the heirs need to distribute it all in the year it's inherited, and it's all ordinary taxable income. The magical tax-free aspect of it goes away. However, and this is what I just found out, like if you leave it to your kids can use can take distributions tax-free to reimburse expenses you had while you were alive that you did not already reimburse yourself from the HSA. But
can they go back to all the Medicare premiums that their parent paid all those years?
Well, here's the rub. I don't know how anyone would ever have the pay. Well, maybe some people are super anal about it, but I don't know how your kid would find out what expenses you had, what wasn't paid with HSA deduction. So I feel like that's asking for trouble. But in theory, not in theory, but per the HSA distribution form, in the tax return 888889, I think. Anyway, you can do that.
Yeah.
Any amounts that aren't distributed for those are fully taxable to the heirs. So
one thing I would think about, I'm an executor in an estate right now. And for example, especially after someone dies, you typically start getting, the medical, the receipt, you get the medical bills, not necessarily bills, but you get those receipts in the mail. So yeah, the executor of the estate could technically maybe find out who those healthcare providers were and try to reimburse the HSA. But yeah, again,
how would you know those expenses weren't already reimbursed? Like it would take
rabbit hole stuff. Yeah.
You'd have to go through like every year's tax return to look at HSA distributions. And I just, who knows, maybe the IRS isn't a big enough issue that they're even going to bother looking. But I'd be suspect if you inherit $100,000 HSA from your deceased parents and you claim a $90,000 deduction for medical expenses they had while they were alive. That feels like asking to get flagged. But
anyway. There's a quick comment. So HSAs can pay for Medicare Part B and Part D, but they cannot be. But Medigap or like Medicare supplement plans are not considered medical expenses for the HSA.
Yes, that's correct. Yep. Cody. Curious what Cody thinks about 72T, substantially equal periodic payments for early retirees prior to age 59 and a half. I used to think it was too complex, but I finally dug into it, and it seems pretty straightforward. Harsh penalty if you don't follow the rules, but otherwise appears doable. Yeah,
so a big thing with 72T, so substantially equal periodic payments is a way to get money out without the 10% penalty before 59 and a half. And really what that means is like, it's in a way you can, we talk about RMDs a lot. You can think about it kind of like as an RMD, like you take out a certain amount, but it has to be the greater of 5 years or 259 and a half. What I've seen kind of this, so this is great if you kind of, you're going to need this income like through age 59 and a half. And it's one of those things that whether or not it's flexible to turn on and off depends. Again, this is like kind of beyond the scope. But one thing to keep in mind is some people start the 72T, and then like they get an inheritance or like another income source comes through, or they end up going back to work, or the spouse gets a job, and then they end up with taxable income that they actually didn't end up needing. So yeah. I think so. The rule of 55, 72T, and especially maybe we'll cover Roth conversion ladders at a later time. With the for early retirees, those should not be. I don't think that they should be priorities for early retirement income. I think taxable brokerage accounts have a lot of cash flow flexibility that should be considered first.
Yeah, it's definitely doable, but it's not flexible. You can change once, and so there's 3 different types of payments you can choose. I forget. I did a video about drawing a blank on it. One of the types allows you to make a once in a lifetime switch to the other type. But outside of that, you can't take out more, you can't take out less. And like Cody said, you have to let it run till the greater of your 59 and a half or 5 years.
That's the big part. Yeah.
So really think this thing through carefully before you do it, because you don't know what life changes may happen, how your income's going to change. So there's inherent value in flexibility, not being tied down. It can't quantify it, but that's one of the things. Do you avoid this for the sake of keeping flexibility? If you have no other option, then do it. But I like optionality and flexibility.
Yeah, if your only choice is to like take money out with the 10% penalty, then you have to look at your income. Sometimes it makes sense, like even in the long run, to the additional 10% tax can still be lower than what your tax rate was before.
Yeah, it's possible.
Blah blah blah.
I forget the answer to this, Cody. Do you know? Oh no, that's not it.
Can I watch Netflix? Yes.
Yeah, Netflix.
Yeah, share your password. Yeah.
Can HSA be used for COBRA premium? So COBRA again is it can. Okay, yeah, that's right. There's something that it can't be used for.
Or if you're unemployed, there's a few. I'm sure. Yeah, the big things that you can't. Where they. So another thing too is a big thing while you're working. If you're looking at your pay statement while you're working, your medical premiums go in pre-tax, not just pre-tax on the income tax level, but also the self-employment tax is like excluded, cafeteria plans. But when you're no longer working and you're paying for like a like a marketplace plan, you're only going to be able to get a deduction on that if your AGI, if your medical expenses exceed 7.5% of AGI. So you're most likely going to be paying medical expenses with after-tax dollars versus pre-tax dollars while you're working. Just a awareness thing again.
Okay. Comment about HSA and how it's not great to leave to someone. So large HSA, split up the beneficiaries amongst multiple beneficiaries and nonprofits to minimize the tax. So yes, whether it's a IRA that would otherwise be taxed in a living, breathing person's hands, or an HSA that would be taxed in a non-spouse hands, leaving things to charity is a good way to, the only one who misses out is the government. You don't pay tax on it, the charity doesn't. So that's a good planning opportunity.
Quick thing there is if you know a beneficiary who has, who's filing their own return but has very, very low income, it can make sense to make them a beneficiary of something like your, like when I was a power of attorney for my grandmother, I was able to help her change her beneficiaries so that when the money was distributed within 10 years, it was distributed to the people with the lower at lower income rates. So that's exactly a planning tool.
And for your information, Cody has been an asset as an additional moderator of this group!
Nice. Thankfully, not a liability.
Yeah. No, definitely an asset. Do you think you can use your HSA? A lot of HSA questions to pay for the upfront buy-in fee to get into a continuing care retirement community, since it's partially for your future long-term care? I don't know.
No. Yeah. Well, so that's the thing too. Medical. When you're living in a place, this is like one of those like more research, but it also depends how much of the expense is related to medical versus like just living there, right? So assisted living, independent living might not necessarily, the full expense be medical related.
Yeah.
So.
Yeah, I know when you so this question is specific about the buy-in, but if you're in a home or a care facility where there wasn't a buy-in, you're just paying month to month, they should split out for you how much of your monthly bill is for qualified medical expenses versus room and board effectively. And only the qualified medical expenses are eligible to be reimbursed with the HSA. With a CCRC, and I'm trying to find a guest to come on and talk about these because I think they're really interesting, but it stands for Continuing Care Retirement Community. It's basically a place you buy into where there's different stages and phases of housing provided from you're completely independent on your own. You don't need any, ongoing medical help. So you basically live in a condo type place. As you progress throughout life and your mental or physical state wanes, you can move to different types of housing within the community that have higher levels of care, all the way to the point where there's even hospice in these places. So there is a buy-in. You need to, and it ranges depending on the quality and how fancy the place is. I would doubt that the buy-in is able to be spent with HSA.
Yeah, kind of like the down payment, like to reserve your spot. Kind of
exactly.
Thing. Yeah.
I don't know for a fact, but I'd be very surprised if you use your HSA to use the buy-in.
And I would say, so like I've had like my grandpa had Parkinson's, Lewy body dementia and stuff. Being this is certainly something to consider, because if you've known people in your family who have dementia and like any type of memory care issues, it can be very difficult to try to move to a facility once you have a lot of those cognitive issues going on. So living in a place where you can, still have familiarity with where you're living when you go through those, those are very important things to think about.
That's a great point. We're not lawyers, nor do we play one on Facebook Live, but Tony asked, what about the threat of a lawsuit against you if you have a 401k versus an IRA, which is more secure? Thoughts?
I think that you've probably thought about this one more than I have. I know that you did some research.
Yes. So it is true that employer plans that are covered by ERISA, ERISA, which is this federal regulation that protects private employer plans, not public ones. So not like municipal employees. Yes, there's unlimited bankruptcy and creditor protection for all assets in a 401k. So whether you go bust personally and creditors come after you, they can't touch it. If it's a slip and fall, someone breaks their neck and sues you for $5 million, they can't touch your 401k. So
O.J. Simpson. That's the O.J. Simpson. So so he had his NFL pension was like they couldn't touch it. All of his money for all of his retirement. So that's the only way I remember that. Like it's protected against 401ks.
Yeah. Okay.
IRAs, I think you've done more research on.
Yeah. So that's true about 401ks. Now, from what I've read, again, I'm not a lawyer, but this appears to be the correct answer, is if and when you roll over the 401k into an IRA, the amount that was rolled maintains its unlimited amount of bankruptcy and creditor protection. Separate from that, amounts you contribute to an IRA have their own level of bankruptcy protection federally. That was put in place 2005, I want to say. And that's indexed for inflation. It's about $1.3 million. So the way to think about it is whatever you rolled, completely protected. Whatever you contributed, protected up to about $1.3 million this year. But that part's only protected against bankruptcy. Slip and fall damage, that's at the state level, and each state's a little different. So you kind of have to look into your state and see if you are in a litigious profession or you have a lot of rental properties and you're at risk of someone falling out of a window or something. This may mean more to you, but for the vast majority of people, I'm of the opinion that the legal protection differences, to the extent that they come into play at all for you, aren't something that should stop you from rolling things over.
Real life situation. I worked with somebody who they were in the middle of a lawsuit and they were worried that they were going to have to, pay out money. And, they didn't believe that they were guilty or anything, but they were saying, should I move my IRA money into my 401k? Thing is, that's probably not a very good action to take if you're currently being sued. I would just say, if you're in that type of, again, this is like a lawyer.
It probably gets clawed back, I would guess.
Yeah. Just like, hey, I'm trying to shift assets during a lawsuit. It's probably a little too late.
Okay. And if you're a former NFL player, you have a lot of money in your 401k, and you plan on knifing your wife and her boyfriend, then probably just leave it in your 401k. So, right. That'd be sound advice. Tressa Wood, do we really have to know beneficiary social to name them as a beneficiary on a bank account? If we know their name and address, that used to be enough. So for me and my clients at TD Ameritrade, no, they don't require social. It is a field on there, but name and relationship to you is all they require at a minimum. I would like to think social helps get rid of any potential ambiguity or questions, but I don't know. What's your experience, Cody?
Yeah. I just I know a lot of people who are concerned about privacy. Most from what I've seen, most don't require it. If you say I don't want to put it, ultimately this is one more way to ensure it gets to the right person that you intended. For example, if you have, there's a lot of these families. They're like, I'm John the Fifth, I'm John the Fourth.
Yeah.
If it just says, John Smith inherits this, you're like, okay, well, there's a few John Smiths, and they're both grandsons on different sides of the family. So I think ultimately the SSN is just to make sure that it transfers to the correct. So when somebody passes, the custodian needs a copy of the death certificate, and they're going to ask for that personal information of the person they're transferring the account to. For that person to open an account, they're going to need an SSN as well. So I think it's just an easier way to transfer assets if you're willing to put that information out there for them.
Yeah, great point. All right, we got one more question. If anyone else has, feel free. I don't know, let this keep rolling for a little bit, see what happens. But Cody, what are your thoughts on free retirement tools specific to decumulation that are publicly available? Are they good enough?
Good enough.
Not good, but good enough.
Well, what's interesting is, so as an advisor, as a planner, I use financial planning software, but I specifically, for the most part, I don't like to dig into it too much, because again, going back to anytime you get a retirement tool, you're making a lot of assumptions, a lot of long-term assumptions. I always say the more assumptions that we make, the less correct the plan is likely to be. And I think any kind of free retirement, if you're like new retirement does have a new, so new retirement, first of all, is like it's kind of like the software I use, but for retail, retail investors and families. The big thing about free retirement tools is that, again, just be really, really careful about your assumptions for investment returns and inflation rates. I've seen a lot on retirement tools. Somebody will say like, hey, look how I'm on track. And they've set, they say, I've listened to somebody on the radio who said you always make 12% annualized return. And, inflation's the lowest it's ever been. So don't worry about it. Right. So, I would check out New Retirement. They're definitely building out a lot of tools. I'm not affiliated in any way. But that's the one that I know you can actually kind of create like, long-term planning. But again, I would really focus on only looking at like maybe 5-10 years out, not like trying to figure out what, my electricity bill is going to be in 30 years, because it's going to probably be a little bit different.
And I'll give my thoughts briefly, but just whoever this person is, can you answer my question I asked a few minutes ago? I don't see other pending questions. Can you just, I thought I hit them all. Can you just plop up again, whatever your question is? And
catch them all, Andy.
Shows up. Yeah, I'm trying. So my thoughts, whether it's free tools or even paid ones I use, yes, we're projecting out 30 or 40 plus years, making lots of assumptions, granted assumptions based on good, logical, defensible guesses and partly history and a little bit of random number generators, honestly. They tell you kind of orders of magnitude. Never get hung up on my report says I'm going to die with, $2.37 million. That's not going to happen. Maybe it coincidentally will, but chances are it'll be a lot more or potentially less. So the tools are good for broad stroke planning, for if you can use multiple tools or multiple different types of analysis and they all sort of triangulate and get to the same answer. That's frankly the best you can hope for. It's impossible to predict the future with accuracy when we're making assumptions and guesses about your own longevity, about how much you're going to spend every year for the next 4 decades, about future returns of stocks and bonds and what interest rates are going to do, about inflation, about tax legislation, right? I'm sure I just scared you all to be like, why do we even bother trying? Because there's no way you're going to get any of these things right. Doesn't mean we don't try. Whether it's a free tool or like the much more robust tools that are paid versions, there's still lots of educated guessing, frankly. Now that's some people aren't okay with that answer, that I can't tell you with certainty that you're 100% going to be fine, because there's so many things can change, including your own life circumstances. But based on all these tools, it's kind of the best we have. And they all, as long as you understand what they do and what their inputs are,
yep,
and understand how to interpret their output, you can give defensible, logical, yes, things look good based on this, that, and the other, to do whatever it is you're trying to do. That's kind of it. And this is also why I don't use Roth conversion calculators that quantify you should convert exactly $343,000 over the next 3 years. That's pointless. That level of granularity, you're just making random guesses. And the danger is once you see that number, whether it's right or wrong, you're going to see it. It's going to be burnt in your head. You now have an anchoring bias that, oops, I need to convert 343,000. Anytime someone tells you or recommends otherwise, your brain's going to struggle with that. So,
so I was just going to say that any retirement tool here, whether it's free or you purchase it, really you see that as like a 20,000 foot view. 50,000 foot view, whatever. Like, I think that planning tools are great to conceptualize. Like, for example, to see like, oh, wow, my RMDs look like they're going to skyrocket. Like, that's just, like that, I think planning tools more give you that like SWOT analysis, like the strengths, weaknesses, opportunities. What's the T again?
Threats.
Taxes? No.
Threats. Yeah. Well, in our case, that's
yeah, that's the threat. But yeah. So somebody asked like, what tools do we use for planning? I use eMoney for like financial planning. Again, I don't really use it. It's not like my primary tool for planning. Actually, it's funny. My main softwares are Microsoft Excel, Microsoft Word, and like my Acrobat PDF reader. Yeah. Those are the biggest tools I use.
Same. eMoney is my engine for things. And I should back up. It's not that I don't give people finite answers about how much should you convert this year, for example, but like longer term planning, I think trying to get that specific is exercising futility. But for current year, yes, very much we do weigh what tax bracket you're trying to stay in, what's your IRMA threshold, what are your wages, and we do nail down, okay, convert $32,000 this year. But year by year, the whole plan, the plan will change. I'm going to steal a term from Roger Whitney. You have to be agile, even in retirement. A lot of this is a moving target. Which again, I know some people that's not a comforting answer, but it's kind of the truth. You have a plan, that's kind of your roadmap, your flight map, your flight plan, if you will. But even the best laid flight plan is going to change because there's unexpected turbulence or whatever, and you kind of have to adjust and adapt. Retirement planning is the same way, for better or worse.
Yeah, I said that the first casualty in a war is the plan.
Yeah, exactly.
But without a plan, it's a lot harder. Yeah.
Failing to plan is planning to fail. Or something. Yeah. This may have been the question the person asked that I didn't see. Does a trust receive a step up in basis after the death of the grantor, or does the stock have to be given out to the beneficiaries for them to sell with a step up in basis? I'll defer to you because I don't know the answer.
So I'm thinking you're talking about a revocable living trust, which is still considered, so I'm going to space this out, a revocable, not irrevocable, but a revocable living trust is still considered an asset of, is still in the estate of the decedent, the person who died. So, because it's a revocable living trust is a taxable asset. It should, the assets within the trust should receive a step up in basis. Ultimately, I'm a little confused on the second half, but ultimately, those assets will receive a step up in basis. And then ultimately that step up will be, that adjusted basis should be, that's another thing. When it's given, when those assets are distributed to the beneficiaries, just ensure that the adjusted cost basis is updated correctly. That's something I see wrong a lot, is it doesn't have an updated cost basis. Yes, the assets within the revocable living trust receive a step up based on current legislation.
Yeah, assuming it's a living, the most common plain vanilla living revocable trust. Yes, that's the case. I kind of dodge this question because there's lots of ways trusts can be structured. If it's irrevocable, IRR evocable, that I don't know the answer to, but I'll assume that they're asking about revocable, which is most common.
Yeah, estate planning's fun, but yeah, definitely out of our ballpark.
All right. There's still, more questions coming. Let's set a hard stop. 10 o'clock. That's 28 more minutes. You okay with that?
Yep.
This will be a new record for longest.
You mean 18 minutes? Is it 18? Right. How many?
I can't count. Yeah, 18 minutes. Sorry. Right. Yeah. Okay. What's this? Pros, cons of Roth IRA versus Roth 401k. Are you able to take out the contributions of a Roth 401k before 59.5 like you would be able to with a Roth IRA? Do it. Okay, so yeah, they have the same rules in terms of getting money out. So the well, but unless they
my brain's kind of going crazy right now. But yeah, I mostly focus on like the distribution rules of Roth IRA. So let's see. Well, one thing about the Roth 401k, again, because your 401k is like this whole thing. Like your employer contributions are pre-tax, yours are maybe Roth, and the growth on yours is growing tax-free. I think this comes back to the plan to figure out ultimately talk to a custodian for how it's distributed, just to make sure that you're not dealing with penalty. For the most part, you would most people, they would roll their Roth 401k. In terms of flexibility, they roll their Roth 401k into a Roth IRA. Then the original contributions that you made within to the Roth 401k remain treated as contributions and can therefore be taken out without penalty or tax at any time, at any age, for any reason. But yeah, usually I haven't actually dealt with anybody taking money out of a Roth 401k. I've usually seen that rolled to a Roth IRA before taking any distributions.
Yeah, and I think part of the problem is going to be, yes, distributions from your Roth 401k are completely allowed at any time in theory. However, if you're still working, your plan may not allow in-service distributions. So you're going to be full stop prevented from taking any money out. Even if you retire at whatever age and leave money in your Roth 401k and you try to take some out, as we were touching on before, the plan may require you to take money out in equal, in prorated portions across your various accounts. So if 2/3 of your 401k money is traditional pre-tax and 1/3 is Roth, you may not be able to cherry pick and take out just the Roth. You may have to take out, 2/3 of everything is going to be taxable, which may defeat the purpose. Roll to an IRA and all of a sudden you're good, or roll to a Roth IRA, I should say. And then like Cody said, all those contributions that you made to your Roth 401k, yes, then can come out of your Roth IRA scot-free. Okay. If Facebook user retires at 57, transfers from the thrift savings plan to traditional IRA, so I'll assume it's pre-tax thrift savings plan, and 20% of taxes are withheld, we'll stop right there. When do I transfer to Roth IRA, and do I have taxes held again?
So when you move from a pre-tax, qualified retirement vehicle to another pre-tax, your traditional IRA, that will not be a taxable event. You should actually have nothing withheld when you do that transaction. And then the second part, so it's when you transfer from that to the Roth that it becomes a taxable event. Andy, what is your take on there?
That's correct. So assuming it's pre-tax money from your TSP and you do, you properly roll it over to a traditional IRA, it's not a distribution, it's a rollover / transfer. So no taxes are withheld at the time. It's not a taxable event. When you say transfer to a Roth IRA, you don't transfer, you technically convert. And yes, upon the conversion, taxes are due. Whether or not you have taxes withheld or you pay taxes separately out of pocket, whole different ball of wax.
I think the words, language matters. It's like, contribution, you make a contribution to a retirement account, then you roll it from from a pre-tax 401k or your TSP to a traditional IRA, and you convert it. Conversion is a change in tax character, right? So maybe, Andy, do a video on the 3 different words and how they're different later.
That's not a bad idea. All right, this is the last question. So we'll wrap it here. I don't see anything else in the queue, so we'll call this one the last one. For retirement planning, are Monte Carlo simulations a must? Why are you laughing? What's so funny?
At this question, because it just cracks me up.
In a good way.
I'm not laughing at the user.
Yes, are Monte Carlo simulations a must, even for people who are about 20 years away from retirement? So I'll say what Monte Carlos are. You can answer the question. We just got another question. Okay, maybe we'll keep going. So a Monte Carlo is basically a statistical analysis that takes your current portfolio, your current assumed expenses throughout life. It also assumes some inflation increases and runs through e-money that we uses 1,000 different statistically possible outcomes of how much money you may end up with based on, one of the 1,000 trials will be 20 years of really good markets followed by 1 year down and then, 19 more years up. And the bad one will be 20 years of down markets followed by 1 up and then all sorts of combinations in between. So it's not saying these will happen. It's just saying statistically they're likely from super, super high end, super, super low and everything in between. And then you look at the outcome and look at how many percentage of these 1,000 runs ended up with me not running out of money, basically. That's Monte Carlo. So if you're 20 years away from retirement, what are your thoughts about using this?
So, So the reason I laughed is that let's say you're 20 years away till retirement, and then retirement's going to be another 30 years. We're talking about 50 years. Yes, there's 1,000 simulations happening, right, based on historical, risk measures, risk and return measures. When you look 50 years out on Monte Carlo, this is what's crazy. It'll say you have a 93% chance so you have a 93% chance of success, which means 93% of the time you didn't, you ended with at least $1 in your liquid assets, right? But so it's like but when you see the range over a 50-year period, you're going to see, hey, you're either going to die with $73 million or you're going to die without any money, right? So the longer, again, coming back to the planning and how it's useful, the longer the time horizon, the more variability, like in the range of returns. So I think it's worth looking at Monte Carlo, especially kind of look at the percentage of success can at least give you some opportunities to think about. If it says 95% chance of success based on these scenarios, that's a lot different than saying 25%. But seeing the whole, that's why I avoid what I call the blue ocean, which is when you see on those reports how much money do I have when I die. That's where it doesn't really make sense 50 years out to say I'm going to either die with 50 million or die with nothing, because I think that's just too long-term planning.
I think there's value in it, even if you are still that far away from retirement, because otherwise your projections are limited to linear assumptions, basically. You're going to assume my portfolio is going to grow at a neat and pretty 6% per year forever. That doesn't happen. Growth doesn't happen linearly. There's going to be good years, bad years, whatever. So I'm not saying don't do the spreadsheet looking annual cash flow projections with linear growth assumptions. That's one data point. That's one tool. And it's a very important tool. Monte Carlo helps try to account for the eventual sequence of returns. Life doesn't happen linearly, like I said. What if there are, multiple bad years followed by a good year by multiple bad years? That's what Monte Carlo is trying to capture the magnitude of, albeit with statistical guesses, but at least things that are quantifiably likely according to stats and logic. So that's why I said before, triangulate different analyses, different tools. If all the things point to yes, this works. Like if your linear cash flow said yes, it works, but your Monte Carlo gives you 25% success, something's wrong. If your linear cash flow says it works, your Monte Carlo gives you, 90-ish% or higher, you're good. The plan works. I can comfortably say the plan works.
Yeah. So so Monte Carlo is like, think about Monte Carlo as this guy when you're doing this free tool. Monte Carlo is the guy who's like he's giving you more of an objective opinion about how your plan would go versus you. It's kind of like bringing in a third party to say, like, to take the emotion and behavior out of the planning and just say, like, statistically, quantitatively, like, it's very robotic. Again, robots can be good or bad, but I think it's useful to have Monte Carlo to just be like a third party to say, hey, by the way, how you're allocated currently or how you wish to be allocated moving forward, this is the historical measure of success.
Yeah. I know I said that was the last question, but I swear 9 more minutes with the hard stop, 10 p.m. Eastern. In our individual practices, do we focus on which specific investment withdrawals are taken? I guess the question is like which actual assets are sold to get the distributions withdrawals needed.
Specific
Cody?
I'll talk mostly like broad, I guess, in my answer in terms of I really think about tax location first. Besides just saying depends. I look at that range of the tax location of the pre-tax, the traditional, the taxable brokerage, and then the Roth, like tax-free. And ultimately, you have to, kind of the traditional model is to use like your cash and savings and taxable money first, right? Mm-hmm. And that's typically like if you can meet your lifestyle expenses just with like your taxable assets and cash, then you look at opportunities to like do conversions, because then if you just take it from your cash, let's say you just take it from cash to meet your lifestyle needs, the thing is you have a lot of like range for taxable income you can take on purpose, right? So usually you're starting with taxable, then you're going for some like traditional pre-tax money, then Roth maybe as a supplement after that. But again, all three, it's not necessarily like has to go in a perfect order. Specific investments, I think both, Andy, you can speak for yourself, but specific investments, I really look at, you can take, when withdrawals are taken, you can either do it like in a rebalancing approach. So for example, like if you started with a 60-40 and now it's turned into like a 65-35, you can actually take your money out in a way to dynamically rebalance it back to 60-40. And you can, therefore the investments are kind of chosen for you. But again, it's not, that's more talking about like a retirement account, a taxable brokerage account. You have to look at the cost basis, the unrealized versus realized, and really do a deeper tax dive before you just start selling stuff.
Yeah, I'd agree with that. IRAs, Roth IRAs, HSAs, 401ks, any qualified account, there's no tax implications to what you buy and sell throughout the course of the year. So you can rebalance, you can trade in and out of stuff all day long. Not that I'm advocating day trading or anything, but I do systematically rebalance for folks. And yes, if they need a distribution from their IRA and their equities are kind of heavy because the stock market keeps grinding higher, then yes, we'll sell off some of the equities to not only will that give them the money they need for distribution, but in selling off equities, it brings their allocation back in line. The taxable accounts are a very different story. Oftentimes clients have legacy positions, mutual funds they held for decades or stocks they, held a long time, transfer them over. Those we don't just automatically sell and reinvest because there are tax implications. So we just kind of keep them until it makes sense to sell them. Maybe they're in a position where their income plan for the year is, they really want out of this stock now. It has a lot of gain. Maybe this year's year we sell it, take the money, take the profit, deal with the tax implication. The cash proceeds from the sale will be what helps meet their income needs that year. But it does take a lot more work to monitor and manage and make investment decisions around taxable accounts.
That's one reason that you really need, if you're working with a professional, make sure that they understand the tax consequences and do tax planning. If they're especially if they're working with your taxable brokerage accounts before they sell anything, the process should be they should look at your year-to-date realized gains and losses.
Yeah.
Right. And they should look at your unrealized gains and losses in your positions, both looking at how am I going to get back to the asset allocation that we defined, in a relationship, but ultimately like what are the opportunities to sell, to do, we call tax gain harvesting. Sometimes you can actually sell realized stuff at the 0% capital gains rate. You can do tax gain loss harvesting, tax loss harvesting, which is really like finding losses to offset gains to have maybe even no tax consequence to wash out. But yeah, and then there's also opportunities like, if you're giving to charity, like appreciated stock, like there's so many opportunities. And thankfully, I know Andy's created a lot of videos about these things. Maybe we'll post to his YouTube video channel after this too.
Okay, last question. I swear, I mean it. So please, no one else post anything else, because then I'll feel obligated for one of us to address it. So this is it. Does a 401k have to be converted to a traditional IRA before being converted to a Roth IRA?
So I love the word "have" because it's like you can't wiggle around this one. So I'm going to start with the wiggle around, which is like, so you put money from a traditional 401k straight into a Roth IRA. The distribution will be taxable, but in terms of record keeping, right, it's up to you ultimately at the end of the day to say how it's taxable. You'll receive the 1099-R for taking a distribution from your 401k, and it's up to you to make sure that you told them what you did with it. The cleaner way to do it, I know that's kind of taking away from the have, but the cleanest way to do this is move from your traditional 401k to a traditional IRA. That's a non-taxable event. You'll still get a 1099-R, but it'll show, the little code in whatever box 8 will show that, it was moved to another pre-tax account. Then convert to Roth. The reason you do this is you have a lot more flexibility in how much you convert to your Roth IRA. And also the record keeping will be so much cleaner because you're keeping all the taxable events all within one custodian.
Yeah. I'd agree with that. I don't think you have to. What you can do, for example, which I don't think you'd want to, but you can take a distribution from your 401k. 20% tax will be withheld mandatorily. That's federal law. You can do what's called an indirect 60-day rollover, and you can roll it into a Roth IRA. So you'll get a check. Let's say you have $1 million 401k, you cash it out, you'll get $800,000 in your hands because $200,000 will be sent to the government for taxes. You would take that $800,000, and you'd have to cough up another $200,000 out of your pocket to get $1 million into a Roth IRA. That's a conversion.
And then you'll be, in a way, you kind of get paid the taxes when you file, in a way, because
yes, and then you have to pay the taxes on that because you did $1 million conversion. So that's one way to do it. But it's like Cody said, it's significantly easier. Roll your traditional 401k to a traditional IRA, non-taxable. There's no withholding, whatever. Then do your conversion from your traditional IRA to your Roth IRA. I can't think of any upside to doing it any other way, frankly. But no, I don't think it has to be done that way.
And it's box 7, isn't it?
7 has the codes, yes.
Yeah, the distribution code. Yeah.
Yeah. All right. That's it. Thankfully, everyone gladly abided by my plea for no more questions, because like a sucker, I would have been like, all right, let's keep going. So thank you, everyone. Cody, big hit. Lots of, I think you can see comments here. A lot of people super appreciative of
appreciate that,
you being on and sharing your knowledge with us all. So
I exist. I'm real.
He is.
Everybody thought I was just a bot in the group, a bot moderator.
Yeah.
All
right. So Cody, stick around. But otherwise, thank you, everyone. It's a pleasure. See you all next week. Next week's topic, I think, is giving to charity tax efficiently or something along those lines. So, all right. Take care, everyone. Bye-bye.
Bye-bye.